What if I told you that the dream home you've been saving for could be owned before you ever get a chance to bid on it by a billion-dollar company? Sounds like a movie plot, right? Well, it's not. Across the US, institutional investors, giant companies, private equity firms, and hedge funds are buying up residential real estate at unprecedented levels. And it's changing the housing game for everyone. Today on Journey Realty Group, we're diving deep into the world of institutional buying in residential real estate. We'll unpack what's really going on, who the key players are, how it's affecting everyday home buyers, and ultimately, whether or not you should be worried. This isn't just a market trend, it's a movement with major implications for the future of home ownership. Let's start with the basics. What exactly is institutional buying in real estate? Institutional buyers are large entities like hedge funds, private equity firms, REITs, real estate investment trusts, and pension funds. Unlike mom-and-pop investors who might purchase a few properties here and there, institutional investors often acquire homes in bulk, sometimes entire neighborhoods. These companies aren't looking to live in these homes. Their goal is profit, whether through flipping, long-term appreciation, or turning homes into rental properties to generate ongoing income. One notable player is Blackstone, whose subsidiary, Invitation Homes, owns tens of thousands of single-family homes across the US. And this isn't new. After the 2008 housing crash, institutions swooped in to buy foreclosed homes at rock-bottom prices. But what's different now is the scale and the fact that they're competing directly with individual buyers in the current market.
How big is this trend really? You might be wondering, is this overblown? Not at all. In some markets,
institutional investors accounted for 1 in every 7 home sales in 2021 and 2022. That's more than 14% of the market. In Atlanta, for instance, data from Redfin showed institutional investors bought over 20% of all homes sold in the metro area in certain quarters. In Charlotte, Phoenix, and Tampa, the numbers were similarly high. Even more striking, these companies tend to target entry-level single-family homes, exactly the type of property that first-time buyers and middle-income families are trying to buy. This competition often drives up prices and squeezes out individuals who can't move as quickly or offer all-cash deals like these institutions can. Why are institutions so interested in residential real estate? Great question. Why would Wall Street be so interested in Main Street homes? Several reasons. First, single-family homes offer consistent long-term returns. With home prices generally trending upward and rents climbing even faster, it's a reliable income stream. Second, rental demand is booming, especially among millennials and Gen Zers who either can't afford to buy or prefer flexibility. Third, real estate is a great hedge against inflation. Unlike stocks or bonds, real estate values often rise with inflation, making it an attractive asset class into today's economic climate. Finally, technology has made it easier than ever to manage thousands of rental properties. From AI-powered tenant screening to digital maintenance requests, these companies can scale efficiently. The impact on individual home buyers. So now let's talk about how this impacts you, the everyday buyer or aspiring homeowner. Here are 3 major ways institutional buying can shift the landscape. 1. Increased competition. Institutions can move quickly, make cash offers, and often waive inspections. Most families can't compete with that. 2. Higher prices. More demand equals higher prices. In tight markets, this bidding war drives up costs for everyone. 3. Less inventory. Homes purchased by institutions often stay off the forced sale market for years, reducing available housing stock. Let's say you're a first-time buyer in Dallas looking for a $250,000 home. You find one listed, only to discover it's under contract within 24 hours to an out-of-state company that offered $10,000 over asking, in cash. You can't compete, and you're not alone. Is renting the only option? The rise of the forever renter. With home ownership feeling increasingly out of reach, many are turning to renting. But here's where it gets even more complex. Institutional landlords now own a growing percentage of the rental market, particularly in suburban areas. This shift has led to higher rents, fewer tenant protections, and more corporate-style management. Reports have shown that some institutional landlords raise rents aggressively, sometimes double-digit increases year over year. In places like Nashville and Las Vegas, tenants have faced rising costs with fewer affordable options. It's a cycle. Individuals can't buy, so they rent. But as more people rent, demand increases and so does the rent. Meanwhile, the institutional landlords profit. What are the pros of institutional involvement? To be fair, it's not all bad news. Some experts argue that institutional players can help stabilise neighbourhoods, especially post-foreclosure. They often have the resources to renovate properties, improve infrastructure and professionalise the rental experience. For instance, maintenance might be faster, payment portals more efficient, and homes kept in better condition. In communities with lots of neglected or foreclosed homes, this can be a net positive. Plus, institutional investments can bring more money into housing, potentially increasing supply in the long term.
What can be done? Policy?
Regulation and solutions. This rising trend has caught the attention of policymakers. Some proposed solutions include capping institutional ownership in certain zip codes or housing categories, offering first-time home buyer incentives to level the playing field, increasing transparency by requiring large buyers to disclose purchases, investing in affordable housing construction to boost inventory. In Canada, for example, some provinces have imposed taxes on non-resident buyers. In the US, cities like Minneapolis and Philadelphia are considering regulations on bulk purchases to preserve housing affordability. At the grassroots level, community land trusts and non-profit housing coalitions are stepping in to buy properties for long-term affordable housing.
What should you do as a home buyer or investor? If you're in the market to buy,
This might sound discouraging, but it doesn't mean you're powerless. Here are some practical tips. Get pre-approved early and work with an experienced real estate agent who knows how to act fast. Consider new construction where competition from institutions may be lower. Look into first-time buyer programs in your state or city. Be flexible with location. Institutions often focus on high-growth urban markets. And most importantly, don't get discouraged. The market is tough, but opportunities still exist with the right strategy. For investors, this trend also brings an important message. Scale matters, but so does local knowledge and personalised service, something institutional investors often lack. You can still succeed by being niche, nimble, and community-focused.
Closing thoughts. Should you be worried?
So should you be worried about institutional buying in residential real estate? Yes and no. Yes, because it's changing the playing field. Competition is fierce, affordability is strained, and traditional home ownership is facing new barriers. But no, because awareness is the first step to action. By understanding the trend, staying informed, and being strategic, you can navigate this evolving market. At Journey Realty Group, we believe the dream of home ownership is still alive, and we're here to help you every step of the way. If you found this video helpful, hit that like button, subscribe to stay updated on housing trends, and drop a comment below. Have you encountered institutional competition in your area? What was your experience? Let's keep the conversation going. Thanks for watching, and until next time, keep dreaming, keep learning, and keep moving forward.